I wish I knew what investment trusts were, but I'm too embarrassed to ask. When individual investors put money into the stock market, they tend to invest using funds. A fund simply pools money from lots of different investors and invests it in a portfolio of assets on their behalf. A passive fund will aim to track an underlying index. An actively managed fund will try to beat an underlying index or achieve a certain annual return above inflation. Actively managed funds come in two main varieties. There are investment trusts, also known as closed-ended funds, and there are open-ended funds, commonly known as unit trusts. We prefer investment trusts. Why? There are several reasons. But one of the most important differences between an investment trust and an open-ended fund is that an investment trust is listed on the stock exchange. So if you want to invest in an investment trust, you buy shares in the trust itself. This means that the value of the trust is independent of the value of its underlying portfolio, whereas the value of an open-ended fund will always directly reflect the value of its portfolio. Why is this a good thing? It means that the investment trust manager doesn't have to spend lots of time worrying about managing flows of cash in and out of the fund. The investment trust, like any other listed company, raises money by issuing shares. When a new investor wants to come on board, he or she has to buy the existing shares from another holder. The underlying portfolio is untouched. With an open-ended fund, it's different. If you put money in or take it out, it effectively has to go into or come out of the portfolio itself. So if the manager holds a lot of hard-to-sell assets, he or she runs the risk of being unable to sell quickly enough if lots of people decide to take their money out at once. This is how star manager Neil Woodford came a cropper in 2019. So arguably, an investment trust manager is more able to take a long-term view when investing. Of course, the fact that the share price trades independently of the underlying portfolio means that the trust itself can trade at a premium or at a discount to the value of its holdings. To learn more about the opportunities and risks this opens up, and to find out what some of our favourite investment trusts are, subscribe to Money Week magazine.